We're almost there. 1:59. I just saw the message that they canceled in-person classes the rest of the day. My kind of deciding factor was this morning when Fulton school district canceled. I figured out of caution we'll meet over Zoom. But anyway, so we're continuing in chapter 3. We're getting some more practice with our calculations in chapter 3. And I've got some picked out for us. And just like I've told you guys several times before, I just want you to pay attention. You don't have to take any notes or anything. I'm going to send you this Excel file with the answers after we are done. And so you don't have to worry about trying to write it down and watch the screen at the same time. Just pay attention. And then, like I said, I'll send you not only the link to this recording if you wanted to go back and view it for any reason, but then also the Excel file with the answers as well. So let me share my screen and I will get this pulled up. Okay, so this is what we're looking at here. And similar to kind of what happened on Wednesday when we did these, you guys are supposed to do the even for your homework, and I usually do the odd in class together, but these relate to each other. And the way that I like to present the information, we're answering kind of both of the questions. So we're going to do 17 and 18 together. And so this one, it says, Mini Inc. earns pre-tax book net income of $750,000 in 2021. Mini recognized $20,000 in bad debt expense for book purposes. This expense is not yet deductible for tax purposes. Mini reports no other temporary or permanent book tax differences. The U.S. federal corporate income tax rate is 21%. And then it says Mini earns an after-tax rate of return of capital of 4%. That is not applicable to us, what we're calculating. But anyway, so the way we set this up on Wednesday is we said, okay, we're going to have a column over here for taxable income. And then we'll have one in the middle for the difference. And then we'll have one over here for book income, right? Okay, so it tells us that we're reporting 750,000 of book income. And I'm going to go ahead and turn these into currency. So I know that I'm entering enough zeros. Don't need decimal places though. Okay. And so that book income is after we recognized 20,000 in bad debt expense. Remember, when our expenses go up, our income goes down, right? So this expense is not deductible for tax purposes yet, which means our taxable income equals not only the 750,000 of book income, but the 20, we've got to add back in that non-tax deductible bad debt expense, right? Because until we actually write, until we actually write off an account, we don't get to claim that for tax purposes, right? Of course, the difference here is that 20,000 bad debt expense. All right, so now we just multiply each one of these by 21%. Did someone have a question? No? I know sometimes it picks up background noise. I changed this to currency and forgot that this is actually a percentage. So 21%. Oh, hot dog. Ragga schmagga ragga fragga ragga ragga. 21%, right? We need to multiply it by 21%. And then same thing here. We need to multiply it by our 21%. Okay, so taxable income equals 770,000 times 21%. So income tax expense, 161,700. The bad debt expense. Now, this is actually going to give us a deferred tax asset because we're paying taxes on it now. And then eventually we're going to be able to claim the deduction in the future. So this gives us that deferred tax asset. So equals 20,000 times 21%. And then finally 750,000 times 21%. All right, so we've got all of our numbers here. What it was actually asking us to calculate on number 17, it was asking us to calculate the current income tax expense. And so our current income tax expense is the 161,700. That's what we have to pay currently. This is our current income tax expense. And then on number 18, it was asking us to calculate, let me see, let me get it pulled up in our book. I know that, let's see, that's my intermediate book. Here's my taxation book. They were asking us to calculate the other two portions. The income tax for book purposes, and then the deferred tax portion of that. This particular problem, it's on page 32 of our book, but number 18, it says using the facts of problem 17, determine Minnie's 2020 deferred tax asset or liability and the deferred tax benefit or expense and total tax benefit or expense. So here's our deferred tax asset. Right, the 4,200 deferred tax asset. And then our total, according to our book income, here's our total tax expense. Okay. And again, this, because it's a deferred tax asset, we're paying taxes on it now. And we're going to be able to basically claim that deduction for tax purposes in the future. So it's going to reduce our taxes in the future. So it's a deferred tax asset. And where did it, let's see here. I thought they had one where they showed us an example of one with a bad debt expense, but of course, since I'm looking for it quickly, I can't find it. Oh, here, I got it. Page 15, they showed us an example of this. And then again, just to remind us that journal entry. So we would debit income tax expense for the 157,500. Since it's a deferred tax asset, we know that assets increase with a debit. So we're debiting deferred tax asset 4,200. And then we credit income tax payable. This is the amount we actually have to pay, is what that journal entry would look like. Okay, looking all right. Does that make sense? Any questions about that so far? Okay, well then let's look at another example. And now this is 19 and 20, again, similar to the previous example we just did. These link together, even though you're supposed to do 20 for your homework. I went ahead and just put it together because they go together like that, right? So this one, and again, I'm going to go ahead and just make our columns here. So we've got taxable income. We have a difference. We're going to have some kind of difference that we're calculating. And then we've got book income. All right, so this one says in 2022, Mini reports 800,000 of pre-tax book net income. Okay, so there's our book income, 800,000. Currency, and we do not need decimals. Okay. And then format these. There's something I always forget to do when I'm setting up these schedules. All right. So Mini did not recognize any bad debt expense for book purposes in 2022, but did deduct 15,000 in bad debt expense for tax purposes. Okay. So now we probably claimed this bad debt expense in a previous year for book purposes. Now it's reversed itself out and we can get the tax deduction now. We actually wrote off the account and now we can get the deduction for tax purposes. So if our book income's 800,000, that means our taxable income is 15,000 less than that, right? So equals 800,000 minus 15. Because now we could claim this bad debt expense for tax purposes. And this is what, a difference of 15,000. That bad debt expense. It says Mini reports no other temporary or permanent book tax differences, and then the applicable rate is 21%. Just like we saw in our previous examples, we're using that 21%. All right, so we've got 21%, 21%, 21%. Okay. So now we can do our math, 785 times 21%.
Like Pulitzer Prize.
Times 21%.
Won't do it alone. I need researchers, surveillance, private investigators, the full resources of this paper starting right now.
Okay. All right. Let's see. And then book income equals 800,000 times 21%. Okay. So in number 19, they were just asking for our current tax expense. So again, that's what we have here. I'll highlight it for us. This is our current tax expense. And then they were asking for these other two amounts for number 20. So that's why I say we just kind of do both of them together. No biggie. Saves you a couple few homework assignments, right? And then the total tax expense, right? Total tax expense is our 168,000. And then our deferred portion deferred tax. So yeah, not too bad, I think. How are we doing with that? Does that look okay? Okay. All right, good. Let's look at our next one then, number 21. And so I'm going to set this up similar to how we set up the previous few that we've done. So again, we've got taxable income. We're going to have a difference. And then we've got book income. This is just the way it always made the most sense to me. But anyway, this one says Ovate Inc. earns 140,000 in book income before tax. All right, so 140,000 book income before tax, and is subject to a 21% marginal tax rate, right? That's our federal income tax rate. So let me do this. So we've got currency for our amounts. Then we'll do percentages. Oh, hot dog. For our percentages. Okay, so Ovate Inc. earns 140,000 in book income before tax and is subject to a 21% marginal federal income tax rate in its first year of operations. Ovate estimates it will incur 6,000 over the next 2 years to honor warranties on products it sold during the current year and recorded the appropriate liability on its balance sheet at the end of the year. So to arrive at our book income of 140,000, we claimed a warranty expense of 6,000 basically, right? But similar to bad debt expenses, we cannot deduct the warranty expense for tax purposes until we satisfy that warranty obligation. Until the warranty services are performed, essentially, right? So if book income was 140,000 after we claimed or reduced that income for the warranty expense, taxable income is going to be 6,000 greater because we can't claim that for a tax deduction yet. All right, so we're going to say 140,000 plus 6,000. And of course, we've got then that $6,000 difference. All right, now 21% is our rate. And so we can do our math here, equals 146 times 21%. For our difference, 6,000 times 21%. And then for our book income, 140,000 times 21%. Okay. So what is this one asking? Determine the amount of Ovate's deferred tax asset and liability, or liability, if any, at the end of the year. So here is our current tax. This is going to be a deferred tax asset. And then this is our total income tax. Right, so there are our amounts there. And just to remind us of what this entry would look like, I know we saw the deferred tax. Let me think about this for a second. Yeah, that's right. That's right. So we saw what that journal entry would look like, right? We would debit income tax expense for the 30,660. debit deferred tax asset. 1260. Oh, hold on, I'm going backwards here. Hot dog. Debit, good grief. Income tax expense. 29,400. Credit, excuse me, debit deferred tax asset, credit income tax payable. For the 30,660. Okay. How are we doing with these? Making okay sense so far. When we come back together next week, because so far when we've been calculating these, let me scroll up a little bit here. So far when we've been calculating these, we've been just looking at the first year of when the difference happens. Now, when we come back together next week, we'll look at the second year. So what happens when the difference reverses out, basically, if that makes sense to you. So that's what we'll get practice with next week. But any questions about what we did together today? Is that looking okay to us? All right. Well, I thought that those 5 that we had would take us a little bit longer, but we got through those pretty quickly. Is there any other questions that we have for our tax class relating to any other items? No. I know for you guys, you've had to do this Zoom thing a few times today, so I won't keep you on here. I just wanted to get a little bit more practice. And like I said, when we continue on next week, we'll get some more practice. But does anybody have any other questions right now? Okay, guys. Well, then that's good. You know where to find me if you think of anything else. Otherwise, we'll come back together next week and continue on in chapter 3, okay? Bye-bye.
Thank you.
Thank you. Have a good weekend.
You too. Bye-bye. Stay warm.